Welcome back to another video, guys. In this particular video we are going to talk about monetary policy. So here are the session outline. Guys, first of all, we will speak about what is the monetary policy, and then we are going to talk about different types of monetary policies. There are two different types, basically dovish policy and hawkish policy. However, there are different terminologies which are also being used by investors in this forex world. We will speak about all the terminologies which are being used for dovish and hawkish. Moreover, we are going to talk about the impact of monetary policy, which is the most important thing to know. The sole objective of this particular lecture is to make you understand how monetary policy can react or place an impact on the overall financial market, as well as the idea is to give you an indication like how you can predict the monetary policy in advance. By doing so, you will be staying one step ahead of other investors in the market, and that's all you need to do in order to take a position on a very good position. Because if you are late in predicting the monetary policy, or if you are late in applying this monetary policy on your forex currency pairs, or maybe in your trading, it means that you are time is money. And let's suppose you were supposed to buy gold on 1300, but you were not able to predict the future, and you were definitely not able to predict the monetary policy. So the prices of gold, for a certain reason, definitely which are related to the monetary policy, the gold prices have soared to 1305. It means that you missed an opportunity to capture 50 pips. So by doing this, like by analyzing the market and by like being able to predict the monetary policy decisions, you will be able to take positions earlier, and you will be staying one step ahead of others, and that's what make you different from immature traders. So by the end of the session, we will be speaking about the trading the sentiments. Like definitely there is not going to be a change in the monetary policy decisions. Like every month, it is not going to happen that the Federal Reserve just hiked the interest rate in January, and in February there is going to be a meeting and they will hike the interest rate again. No, that is not going to happen. However, investors, they will give you the indication about what they expect to do in 2018 or in 2019 or in 2020. So based upon this particular forecast, based upon this particular outcome, we need to be able to determine the sentiment, whether this is hawkish sentiment or whether this is dovish sentiment. And if we are able to do so, that is going to give us our trades for the upcoming month. Alright, so guys, when we spoke about the market analysis, we also spoke about there are three different types of market analysis. First of all, fundamentals, technicals, and sentiment analysis. Today's session is about fundamentals analysis, but we are also going to work on sentiment analysis. Like based upon fundamentals analysis, you should be able to analyze the market sentiment. Okay, now let me give you a really quick idea what is sentiment analysis. Guys, sentiment analysis is what others are thinking. I simply need to be able to understand what 70% of investors in the market are thinking. That is not very hard to do so, because investors follow the herding behavior. They all move like they all will be entering into the buying position at the same time. They will be like based upon certain news, they will be selling off the stock or selling off the dollar index, or they will be entering into the buying in the dollar index or in the stock market. That's a herding behavior. That's how market moves here in the not only in the stock market but also in the forex market. They all follow herding behavior. So based upon the fundamentals analysis, we should be able to understand what other investors are thinking. And if we are able to analyze how or what 50% or 60 or 70% of traders are thinking, that means that we are successfully doing the sentiment analysis. Okay, so in this particular lecture, we are going to like by the end of this session, you will be in a position to not only analyze the fundamentals, like what to expect from monetary policy, what to expect from the central banks, but also you will be able to form your sentiments and market. Most of the time, like guys, there is not going to be a major major economic event every day. However, market still moves, and most of the time market is moving based upon the sentiment analysis. So this is going to be very helpful for you. Alright, so speaking about, first of all, a really quick recall of what is fundamentals analysis. Guys, in fundamentals analysis, our idea is the reason why we conduct fundamental analysis is to predict the future prices, because to be a successful forex trader or to be a successful commodity stock or crypto trader, what I need to do is I need to be able to understand the future up to certain extent, up to some extent, right? I will not be able to do so 100% of the time, but if I am successful 90% or 80% of the time, that is cool, because I will still be making money. So all the efforts that we are doing in analyzing the market is just because we want to predict the future prices. And if we are able to predict the future prices, it means that like if I know that the prices of dollar index will fall down in the next week, so it means that I will be able to clear my buying positions, or maybe I will go for short selling the US dollar, because I believe that in the next week or in the coming month the dollar is likely to fall down. So that's what we that's why we perform any type of analysis, and specifically in fundamentals analysis, when we try to predict the future prices, we are basing our decision based upon economic events and the ongoing news. And if you guys remember, in our previous video we spoke about that the most important fundamental information comes from the central banks. Guys, central banks have a capability not only to drive the market, but also to reverse the very strongest trends of the market. I will give you the example of Euro US dollar in the upcoming slides, but before doing so, here are some let me recall that here are some most important and major economic events that you need to monitor on the daily basis. Guys, the CPI figure is released by all the economy, because the inflation figures are very important for not only for the central banks but also for the traders on the daily basis, because they do drive like 100 to 50 to 100 or maybe even more than that amount of pips fluctuations in the market. So the most important economic event comes when we talk about the most important economic events. First of all, we got monetary policy decisions, which also includes the rate decision as well as the press conferences, and then we got the inflation figure, CPI, manufacturing data, unemployment data, and definitely there are some other like unemployment claims, trade balances, and GDP figures as well. So let's move on towards monetary policy, because our today's agenda is monetary policy and its importance. Alright guys, in order to help you understand the importance of monetary policy, here we got a chart of Euro US dollar. It's a weekly chart. Let me select my marker, and you can see here that the thing is the euro was trading somewhere around 1.3127, and the date here is it's 2014. It's September 2014, and in September 2014 the euro US dollar was trading on the top like 1.3120 or 25. So what caused a massive drop in the market? What's the potential reason behind this massive drop? First of all, I'm sure that you are curious to know about it, and I just wanted to like generate this curiosity, because if you are not curious, you will not be in a position to learn. So as we have like drive the curiosity, so let's talk about what's the reason behind this particular sell-off. Guys, the only reason behind this sell-off was ECB, which is the Central Bank of United States. We call it European Central Bank. They decided to cut the interest rates from 0.15% to 0.05%, which is sort of a crazy thing. but they really need this decision to happen, because the eurozone economy was not doing very well. The eurozone applied the sanctions on the Russian economy because of the Ukraine issue, and the Saudi Arabia and the other the United States were also doing the same way. However, we can't ignore the fact that the Germany has some good business relationship with Russia, and they were like re-exporting products to Russia. But as soon as they imposed the sanctions, that was like not in the favor of eurozone. Anyhow, with the passage of time, the economic indicators were not in the favor, so ECB President Mario Draghi decided to go for the monetary policy, and they decided to cut the interest rate decision from 0.15% to 0.05%, which caused a massive drop in the market. Like you can see here, literally the market has dropped from 1.31 to 52 here, 1.04, which is like amazing. It's insane. And for now the euro is trying to recover, but still market is not in a favor. So what caused this particular drop? As we know, that was monetary policy. Now I hope that you understand why monetary policy is so much important. And guys, just imagine if you guys were able to determine, or you guys were able to predict that there is going to be a sell-off in the market, and let's suppose if you had a short sell here, and you hold it until this level is met, then you should be like you can imagine like how much profit you should have made. Or let's suppose if you are in a buy position and you were not closing it because you were expecting that the prices has already gone so much lower and there should be a pullback in the market, and you hold your position, you must have lost all your money. So you can avoid this thing, and you can make like very nice profits if you are able to predict the monetary policy decisions. All right, so by now I hope that you can understand the importance of monetary policy. So let's talk about what monetary policy exactly is, and if and how it serves, how it deals with the money supply. Alright, so guys, here's a theoretical definition for you. Monetary policy is a process by which monetary authority of a country controls the supply of money, often targeting an inflation rate or interest rate to ensure price stability and general trust in the currency. Alright, that was confusing. That was tough to understand. That is not a very easy thing, right? So let me break it down for you guys. Monetary policy is all about it's something. It's a policy. Simply, it's a policy. I'm making a strategy, and I'm going to do so. What I'm going to do so with in order to achieve particular targets. So just like that, we make any policy, we make any strategy. Monetary policy is something which deals with the supply of money. It's only been published just in order to control the money supply. That is why it is called monetary, like something related to money. Monetary policy, the policy which is related to money. Alright, so monetary authority of a country, basically the monetary authority of a country is the central bank. Definitely the banks are monetary authorities of the country. So monetary authority of a country controls the money supply, that is issued by the monetary policy of a country, and in order to control the supply of money. And why we need to control the supply of money, guys? I'm not saying they are going to increase it or they are going to decrease it. The term that I have used is control the supply of money. Okay, why we would like to control the supply of money? Because we want to control the inflation rate, we want to control the GDP, we want to control the unemployment rate. That can be the reason behind controlling the supply of money, and how we do so with the help of interest rate. So monetary policy is a policy which is issued by, let me go back here. Monetary policy is a process by which the monetary authority of a country controls the supply of money, often targeting the inflation rate or interest rate to ensure price stability and general trust in public, or in currency. Definitely they need to be sure that the currency is strong enough and it should be accepted in all over the world. So guys, here are some, like when we speak about the monetary authority, here are some major central banks of the world, and we often trade like euro. You should be trading the sterling, you should be trading JPY, Canadian dollar, Australian dollar, Mexican dollar, CHF. However, there are some major central banks who are always in under the on the radar of investors, because they are going to meet every month. They are going to release the monetary policy every month, and they are expected to come up with something new every time. So that's why you need to know about them. So speaking about, if you guys are looking to trade US dollar, you should know that there's the central bank of United States is Federal Reserve. It is in the short form it called Fed, and the currency is definitely US dollar. So for UK we have the Bank of England. It is abbreviated as BOE. And is in case of Eurozone, we got European Central Bank, which is ECB. In case of Japan, we got the BOJ, which is Bank of Japan, BOJ, sorry, which is Bank of Japan. And in case of Australia and Canada, we got Reserve Bank of Australia, RBA, and the Bank of Canada, which is the central bank of the Canadian economy. Alright, so there are two different types of monetary policies: the expansionary monetary policy and contractionary monetary policy. Guys, in the forex world, the expansionary monetary policy is also known as dovish monetary policy, and in the contractionary monetary policy is known as hawkish policy. Whenever you are referring to the fundamentals on the any sort of news agency website, they will be using the monetary policy was dovish, the monetary policy was hawkish, or the central bank was sounded hawkish, or central bank represented was sounded dovish. So you don't have to be like confused with anything, because these are the other names of expansionary and contractionary monetary policies. However, as it is clear from the term expansionary monetary policy, the monetary policy is all about money supply. And if we speak about expansionary monetary policy, the word expansionary means expanding. Expanding means that we are going to increase the supply of money. So here we have to recall the law of supply to understand how this is going to impact the money, the value of currency. In order to do so, let's suppose the law of supply says we are going to increase, like it's an expansionary monetary policy, we are increasing the money supply. As soon as we increase the money supply, the demand is here, the supply is here. So when the supply is higher, demand is less for any product. Guys, this applies to everything. Like there are 10,000 iPhones in the market, but the buyers are only 5,000. So definitely the shopkeepers or the retailers will be selling it for the lower prices, just to make sure that they are selling something, because they can't bear the loss. So the same case applies here. The demand of money was here, the supply of money has increased, so the prices of, or the value of currency will fall down. So that is why whenever we got an expansionary monetary policy from the central bank representatives, this means that it's a dovish monetary policy, and this is going to increase the supply of money, and this definitely is going to weaken the currency. Just like the iPhone prices got weaker, that is how the US dollar or or the euro or the sterling will get weaker in their value against other things. On the other hand, if we speak about the contractionary monetary policy, it is also clear from the word contraction. We are squeezing something, and what we are squeezing, what we are contracting the money supply. So hawkish monetary policy is all about lowering the money supply. It means that we are decreasing the supply of money. The supply of money has dropped down to this particular level. However, their demand was here. So as soon as the supply fell down, the demand was higher. It means that people will be willing to pay higher prices. Let's suppose there are, let me give you the example of iPhone once again. Let's suppose there are 10 iPhones in the market and there are 20 buyers. So definitely I was willing to buy iPhone, but right now the supply of iPhone is very less. So what I will be doing is I will be willing to pay more prices, or maybe retailers or shopkeepers will be in a position to negotiate higher prices with me. They will be saying like, okay, the price of this particular iPhone is $1,000, but as you know, due to supply concerns, people are also willing to pay 1,300 or 1,200, so you should also pay so it means that a decrease in the prices of a decrease in the money supply, the currency will strengthen, the prices of iPhone will go higher. Likewise, the prices of the exchange rate of the particular currency will go higher. So this is how these are the types of monetary policy. So let me tell you, I'm sure that you must be wondering why we would like to decrease or increase the money supply. Guys, we do so in order to support the economy. We do so in order to improve the employment rate. We do so in order to control the inflation or deflation, in order to improve GDP, or we also do so in order to manage the exchange rate, and in order to increase or increase our import and export. Okay, let me elaborate this. Guys, for example, I am running a corporation. I have a business, and in my business I have appointed like 100 employees. But the problem here is that my business is not expanding. That is stuck at particular level. Right. So let's say my business is, I got 100 employees, and that is my factory. So I got 100 employees herein, and we are producing like 1,000 products, 1,000 cars. Let's say we are producing 1,000 cars, right? So what I need is there are 300 employees, 300 people who are unemployed. So being a central bank, that is my responsibility to give or generate the job opportunities. So these 300 employees will get some sort of employment. They will get paid by the end of the month. So that's my responsibility. Because this is a burden, there is going to be like less demand of product, because these people do not have money by the end of the month. So they are not increasing, they are not demanding anything. They are just depending upon the necessities of life. So being a central bank representative, I will be looking to increase the money supply. I will be making sure that I give loans to these companies. As soon as I give loan to these companies, they will be looking to expand. Earlier there was 100 employees. I will be hiring more employees, maybe 100 plus 50. So which means that earlier there was 300 people who were unemployed. Now there are only 250 people who are unemployed. So unemployment rate should fall down right now. Earlier, with the help of 100 people, I was producing 1,000 units of car, but now I will be producing maybe 1,200 or maybe 1,500 units of cars. Right. So it means that I am increasing production. The output is increasing, which is related to GDP. And then we speak about inflation. The inflation means that earlier there were 100 people who were getting salaries by the end of the month, but right now there are 150 people, 50 more, if we compare it with the past, 50 more people who are getting who are employed and who will be getting salaries, and they will be in the market for making purchases. So it means that the demand is getting higher. As soon as the demand is getting higher, the prices, as we know, the law of demand says the higher demand leads to higher prices. So that's what inflation is. If you recall the previous session, we spoke about inflation. The inflation is a gradual rise in the prices of goods and services. So when there are more people who are demanding a particular product, the higher demand leads to higher prices, and higher prices means that is inflation. So in order to control the inflation rate, in order to control the deflation rate, our central bank decide to increase or decrease the supply of money. And when I spoke about increase manage the exchange rate or increase the business, maybe import and export, guys, the Japanese economy, they are the export oriented economy. So in order to accommodate the exports of their country, what they do is they normally go for increasing the money supply, because when they are increasing the money supply, that makes their currency weaker. But still that is good for them, because the weaker currency means that earlier, if they were getting, let me do so here, earlier they were getting, like, let's suppose $1. Let me change it to the marker. All right, so let's say that $1 was equal to 90 yen, but right now $1 is equal to 100 yen. Or we can say that how we know that the currency has devalued or increased in value. So we can say that earlier I was able to buy $1 for $90, but now I have to pay 100 yens to buy $1, which means that if my currency is getting weaker, for particularly for Japanese economy, if the Japanese currency is getting weaker, which means that earlier when the Japanese citizens were making sale of $100, they were getting like 900 yen, but right now they should be getting like 1000 yen, right? So sorry, that is 9,000 and that is 10,000. So here's the difference. So it means that they will be more motivated to make more sales. Definitely the Japanese economy is heavily depending upon the foreign exchange, so they do like struggle to get as much foreign capital as they can, because the foreign currency makes their makes their economy more stable. So as we are until now, we have discussed about the different types of monetary policies and why they will be going for increasing or decreasing the money supply. So let's talk about what are the different tools that are being used by the central bank in order to control the money supply. The very first tool here is, guys, interest rate, which is we can say that the most of the time monetary policies are focused upon interest rates, and then we got reserve rate, and lastly we have open market operations. Speaking about the interest rate, guys, we got three opinions to trade. What happens if they increase the interest rate? What happens if they decrease the interest rate? What happens if they do not do anything with the interest rate, if they leave the interest rate on hold? So we got three scenarios to deal with. So first of all, we are going to talk about what if they increase the interest rate, and the first thing comes in our mind is the rise in interest rate will lead to lower money supply in circulation. Okay, why that happens? For example, guys, if I was being offered 5% interest rate on the loans, and but now the central bank has decided to increase interest rate from 5% to 10%, which means that I will be less motivated to borrow loans, because this is going to cost me a lot. Earlier I was supposed to pay 5%, maybe $5 against $100, but now I have to pay $10 against $100 loan, which is not acceptable to me, which is not what I can afford. So this is going to demotivate me to borrow money from the bank. So this is not going to apply only to me, but all the investors or traders or all the other people in the world, they are also going to be impacted by the same rule. So let's say they maybe 25% or 35% people will be less motivated to borrow money from the central bank, because now they have to pay 10% interest rate rather than 5% interest rate. So first thing that comes in our mind here is the rise in the borrowing cost will discourage borrowers to take loans. So if they are not borrowing loans, which means that money supply is not going to the market. That is one scenario, which means that the money supply in circulation will drop down, because people are not borrowing loan, they are not borrowing money, and they are not spending it in their economy. Now the second thing that comes to my mind is that earlier I was being paid 5% interest rate on my deposit, but right now I am promised to get paid 10% interest rate on my deposits. So in this hypothetical situation, guys, what you will be doing, like that is clear. You will be saying that the premium is high, so you should rather taking a withdrawal from your bank, rather using the money on any other thing which is paying less premium. Let's deposit money into the bank. Let's keep our money into the bank accounts, so they will be able to your funds will be able to earn 10% interest rate. So this is how, guys, the rise in the interest rate results in the lower money supply. And as we know, the law of supply says that the shortage of something or less supply of something will cause strength in its prices. So that is how it is going to impact the dollar or any other currency. So this is how we can say that currency will get stronger. So whenever we got the increase in interest rate, and by the way, guys, the increase in interest rate means the contraction, because they are reducing the supply of money. So in case of a contraction in monetary policy, we can say that the price of or the strength of currency will rise. On the other hand, if they decrease the interest rate, guys, earlier I was being paid 10% interest rate on my deposit, but right now they have decided to cut it down to 5%, which means that now I will be receiving less return on my investment. So probably I will take a withdrawal, or I will be investing my money into different projects which may offer me high returns. On the other hand, earlier I had to pay 10% interest rate for borrowing, but right now I have to pay 5%, which means that I will be more motivated to borrow money. And probably if I borrow money, I will be investing it into my businesses, and I will be expanding my business, I will be expanding my factory, I will be expanding the units of my factory. So definitely, in order to run a bigger factory, I need more people, I need more marketing stuff, I need more financing people, I need more HR stuff. So it means that I will be offering more jobs, I will be hiring more employees. So in this particular way, not only me but all the other members of the society or the corporate sector, they will be borrowing loan, they will be expanding, they will be adding value to the economy. So the however, so how this is going to if we talk about how this is going to impact the dollar or euro or whichever currency we are talking about, the prices, the supply of money will increase. And as you know, the law of supply says that rise in the supply results in the drop in the prices. So this will weaken the currency. So if you have a news that the Federal Reserve decided to decrease the interest rate, which means that that's a dovish monetary policy. It means that if you hear that the Central Bank of United States has like released a dovish monetary policy, all you need to do is you need to sell the US dollar. So this is how it works, guys. As we spoke about, we will be predicting the monetary policy decisions. So this is how we can do so. By now you should be clear. I'm expecting that you are clear about why central bank decides to hike the interest rate or why they decide to decrease the interest rate. So this happens because, let's suppose, the macroeconomic indicators which we spoke about in our previous lecture, the macroeconomic indicators are not working very well. GDP is falling down, the unemployment rate is rising, the inflation is falling down, and the manufacturing figures are worse than expected. So if that happens, these definitely central banks needs to accommodate their economy, and when they accommodate their economy, that means that they will be lowering the interest rate, they will be making money available to their people. And when this happens, they will be like, with the passage of time, when they have money, they will expand, they will generate job opportunities, they will make more products, they will make more sales. That's how GDP will get better, and that's how their unemployment rate will fall down, that's how their inflation will rise. So guys, in order to predict, we spoke about all this cycle for many times, and I'm expecting that at this position you will be able to predict the monetary policy. Let's do this. In 2016, the unemployment rate was 10%, the GDP growth rate was 5%, the inflation rate was 1.5%. However, in 2018, or you can say that in 2017, the unemployment rate has dropped to unemployment rate has increased to 12%. The GDP figure has increased to 3%, and inflation rate has dropped to 0.7%. which means that in 2017 the economy, let's talk about these are the figures from the US economy, let's say this. So let's suppose in 2017, with the times in the time span of 1 year, the US economy is performing worse than before. The GDP is down, the inflation is down, the unemployment rate is high, and for 2018 our target is that we want to achieve unemployment rate of 8%, GDP growth rate of 6%, and inflation rate of 2%. So I'm sure, like being a let's do this. First of all, before I move towards my verdict, I want you to think in the meantime that what will be your decision, what you will be looking to do in order to achieve these results. So if you are thinking that you will be so if you are thinking that you will be lowering the money supply, that is not going to help. But if you are thinking that you will be increasing the money supply, you should increase the money supply. Yep, that is going to help a lot, because a decrease in interest rate, so ultimate decision is going to be a decrease in interest rate, because as soon as you decrease the interest rate, that will motivate investors to borrow more. That will demotivate like people who got their money in the banks. They will be demotivated and they will be taking withdrawals to invest them in their businesses. So ultimately you are injecting money supply in economy, which is going to support your economy. So probably with more money supply, the businesses will expand, and when businesses are expanding, we will be able to achieve all these macroeconomic indicators. Because business is expanding, I need more more employees. When I hire more employees, the unemployment rates fall down, and probably we will be able to meet 8% target. And GDP, definitely with more employees we will be generating more, we will be producing more, and in this way our output will increase and our GDP figures will rise to 6%. And our inflation will be better, because now there are more people who will be spending a lot by the end of the month, because now they are getting salaries, now they are getting paid. So guys, you can here we can see that how we can predict the monetary policy. So if you are seeing that the macroeconomic indicators from any economy are not are missing forecast, or not in the favor of that particular economy, so you should expect a dovish statement. However, on the other hand, if the economic indicators are outperforming, they are better than expected, they are meeting their targets, so sooner or later we should expect hawkish monetary policy from the central bank. So let me sum up the session. So we can say that the hawkish monetary policy results in the stronger currency, so we should buy this particular currency, and the dovish monetary policy results in weaker currency, and we should sell this particular currency. So this is how investors are going to form a sentiment. For example, the European monetary policy is considered to be like it is expected to trade with the dovish sentiment, because the macroeconomic indicators of the eurozone are not really good. And if these starts getting better, we will start generating a sentiment, we will start trading a sentiment that sooner or later the ECB, which is European Central Bank, will start hiking the interest rate. So it means that I need to buy euro. So guys, that's pretty much it for now. Thank you so much for joining us.